What's up, you guys? Jet here, and in today's video I'm going to teach you how corporate investors view unemployment rate to help guide their investment strategies so that you can too. On the first Friday of every month, the U.S. Department of Labor releases the Employment Situation Report, also known as the Jobs Report or the Labor Report. This report is going to categorize a lot of useful things, but the one that you really need to focus on is
the unemployment rate.
Where's the unemployment rate? The unemployment rate.
But what is the unemployment rate? The unemployment rate is an economic indicator that indicates the strength of the current economy, and it can have a significant impact on the overall stock market. Now, the short-term and long-term effects on the stock market based on the unemployment rate vary. So, we need to break down both. So let's start with a low unemployment rate. So low unemployment rates indicate a strong economic outlook, and consequently, stock prices tend to go up. And the big reason for that is, with more people employed, there is a greater household income. Hourly wages are also usually higher during this time period because employers are having to pull from a diminished pool of potential employees, so they're having to pay them higher rates to get them through the door. The increase in household income correlates with an increase in discretionary spending by consumers on things like traveling, entertainment, home improvement, and investing in the stock market. However, an increase in demand for these sort of discretionary goods usually results in an increased interest rate on borrowed funds. And this is usually done in an attempt to kind of equalize supply with that demand, as well as an attempt to prevent inflation from going too high, heating up the economy too much, and causing any sort of economic instability. So now we need to look at the opposite, high unemployment. Corporate investors realize that a high unemployment rate usually indicates economic distress. That increased economic distress leads to a decreased purchasing power for the everyday consumer. It also results in a decrease in larger companies investing back into their company. So you see less expansion, less research and development, which usually leads to a stagnant or decreased stock price for those companies. And the market sector that is usually hit the hardest during these times is the technology sector. The technology sector is famous for its aggressive growth very quickly, and consequently it has the inverse potential to drop at a very quick rate as well. Now, during higher rates of unemployment, you can typically count on interest rates to decrease and government spending to increase. The Fed usually decreases interest rates at this point to encourage consumers to borrow more money, as well as the Fed participating in what's known as quantitative easing. What that is where the Fed is going to go in and buy a bunch of government bonds that previously had high yields to decrease the yield to encourage the everyday consumer to invest in the stock market and not in bonds. Now, like I said earlier, both the short-term and the long-term effect on the stock market as it relates to the unemployment rate vary. We already talked about the effect of the long term on the stock market. Now we need to talk about the effect on the short term. The effect on the short term for the stock market related to unemployment rate is unpredictable. There are several examples just from the past few years alone where unemployment increases and the stock market seems to rise with it, and vice versa. But why?
The Federal Reserve is expected to raise interest rates several times.
The Fed will want to raise interest rates.
That's right, the Fed and interest rates. There are times where the labor report will show job growth at a slower than expected rate, and the stock market will still increase. And this is usually attributed to the fact that the Fed is taking this as an indication that the job growth rate is starting to slow. So what they do is they begin to lower interest rates for consumers to start borrowing money, which usually relates to an increase in stock price. And inversely, there are times where the labor report shows job growth that far exceeds what was expected, and the stock market takes a tumble. And this is usually attributed to the Fed attempting to slow economic growth by increasing interest rates to help fight off any potential inflation that's coming. And that usually results in lower stock prices. So there you have it. During times of low unemployment rates, corporate investors tend to invest in things like technology, small cap markets, emerging markets, industrials, and materials, and other sectors that tend to do well during an economic expansion. And inversely, during times of high unemployment, corporate investors tend to invest and low risk assets such as government bonds and high quality corporate bonds that have a fixed income associated with them. If you learned absolutely anything from today's video, please consider subscribing to my channel. If you wouldn't mind giving this video a like below, so that way it helps more people see this video. And I'll see you next time.